You're listening to Economics Detective Radio. My guest today is Jonathan Morduch. He is a professor of public policy and economics at NYU and the author of the Financial Diaries, How American Families Cope in a World of Uncertainty, which is co-authored with Rachel Schneider. Jonathan, welcome to Economics Detective Radio.
Hi, it's really nice to be here.
So your book looks at the financial situations of ordinary Americans. It's centered around a detailed survey of 235 households where they recorded what they earned and what they spent at an extremely granular level. So tell me about these diaries. How did they work and what did they record?
Yeah, it's interesting when you say extremely granular. That's exactly right. They are really, really granular. What we did was, instead of doing what most economists do and what I do in other parts of my work, which is look at big data sets with thousands of households where you never really get to know anybody in particular. You're just looking for big patterns. What we did is we stepped back and said, let's get to know some specific households, but really get to know them well. So we selected 4 sites across America: Northern California, Eastern Mississippi, the Ohio-Kentucky border, and New York City. And we selected, in the end, we had 235 households. All of them had working families. None of them were extremely poor or extremely rich. They were kind of in the center of the middle class, although some of them were below the poverty line. But the key innovation was we had a relatively small number of observations, but extremely high frequency. So we visited these households every couple of weeks, and we tracked every single dollar that they spent, that they earned, that they borrowed, that they shared. Like every financial transaction we tried to collect, and we put it into a database, based on basic accounting principles. We had income statements and balance sheets and cash flow statements, but really organizing the survey around cash flows. And that's a real shift from how we usually collect economic data on households.
Usually, the data sets economists work with are things like the current population survey, things that just take a snapshot at the annual level for the most part, just looking at income and expenses, and it gives a very, it's useful for macroeconomists, people who are sort of looking at the economy from a fully zoomed out perspective. But what's really interesting about your data set is just how much more specific you can get and how you can sort of get in there and empathize with specific people and figure out very close up and intimate details that you just don't get from current population survey or other very general data sets.
Yeah, no, that's exactly right. We there were 2 things. One, because it was a relatively small data set, we were actually able to get to know some of the families. And the book tells the story of a number of them. Each chapter highlights one of the families, together with our data, and then connecting it to national data, like the Survey of Consumer Finances or the PSID or other big national data sets. So we don't entirely rely on our 235 families. We want to say, hey, we're seeing something there, but it connects to what we're seeing in other places. But with the granularity, we're able to see a lot that economists usually don't get to see. This is a bit like anthropologists, really getting closer to the ground, and in many ways also being inductive. So inductive rather than deductive. We didn't come with a clear set of hypotheses, and we came with some concerns. We sort of understand what's going on in America in a broad sense. But our approach was pretty hands-off. We just wanted to see week by week how the households were getting by and then tell those stories, which is a very, very unusual thing in today's economic science. So we saw it in a way as a step toward richer theory building rather than as a way to test specific hypotheses.
Mm-hmm. So your book opens with an anecdote about Becky and Jeremy Moore, who are a couple from Ohio. Can you tell me about the Moores and why you chose to start your book with them?
Yeah, Becky and Jeremy were really interesting, and we went back and forth about which households to start the book with. But Becky and Jeremy, they end up showing up through different parts of the book, not just the introduction, but so chapter by chapter, they reemerge. And we picked them because their story connects so well to some of the big themes. And the big themes are about instability and illiquidity that's been hard to see. So let me tell you a little bit about Becky and Jeremy. They live in a small town in Ohio. It's politically a fairly conservative area. It's John Boehner's old district, for those of you who follow congressional politics. And Jeremy is a truck mechanic. He works on those huge, long haul trucks, and he fixes the tires if they blow out, and he fixes the batteries and the alternators. And one of the things which was striking and is part of a bigger story is that in that part of Ohio, people like Becky and Jeremy, who don't have more than a high school education, would have found solid jobs in factories. But those factory jobs are harder to find. And so Jeremy found himself fixing trucks, working on commission. So if he has a lot of trucks that break down, he's got a big paycheck. If he doesn't, he doesn't. And that meant that a lot of the risk of the business was falling on Jeremy's shoulders. So the book starts off with this moment. It was in the spring. I was visiting with Becky, and she was in a sour mood. And that was really striking to me because it was just a beautiful day. It was hard to be in a bad mood, but there was Becky, and she was just complaining. And I said, Becky, what's going on? And she said, the problem is that Jeremy's paycheck is going to be lousy, the next paycheck. And she explained that the problem of being a truck mechanic working on commission is that the trucks break down most in the heat of summer, where the tires blow out, given how hot it is, or the depths and iciness of winter when, the alternators really go and need to get fixed. But, a beautiful spring day, a beautiful fall day, the trucks do fine. And that means that Jeremy doesn't have much work. That means the paychecks are lower. And that was a real struggle for the family. She needed to pay some bills. She wasn't sure what to do. And that became emblematic of what we saw with lots of other households who are facing those kinds of ups and downs in other ways.
Yeah. So if you looked at this household, probably the average income is fairly high. It's reasonable. They're in the middle class, like most of the families you look at. But by zooming in, by talking to them week after week, you were able to find that there's a lot of volatility in the income. And that causes a serious issue for them when they have expenses but not income in some parts of the year.
Yeah, it really goes back to the point that you were making at the beginning, which is, we tend to look at families like Becky and Jeremy through the lens of annual income to say, hey, how are they doing? What's their earnings? And, they were doing okay, about $43,000 a year. They have 4 kids, so things were tight. But in that part of small town Ohio, they could get by okay. But the real problem was they weren't earning that income steadily month by month. Some months and some seasons would be better and some would be much, much worse. And when it was worse, Becky and Jeremy ended up having to get food stamps and state health insurance for the kids just to make sure that everyone was fed and healthy, even though their income was on average, probably sufficient to handle things.
So you have a section on uncertainty in earnings, and You tell the story of a blackjack dealer whose tips literally depend on her customers' winnings at the blackjack table, which is, sort of, it's pretty on the nose when your earnings are literally the result of a blackjack game. So this is part of a broader pattern that you talk about where workers have been taking on a larger portion of the risks associated with day-to-day business fluctuations. Can you tell me about that pattern in general?
Yeah, it's a big story. Risk has really shifted onto the shoulders of people who are working hard, but they're really not in a good position to bear this risk. And there's been economic studies which show this at a macro level, and we were really showing it at a micro level. And what we see happening is what we call a great job shift. So it's part of what David Otter at MIT and his colleagues document as the hollowing out of the labor market, which is that there used to be this mass of solid middle-class jobs for workers, most of whom didn't necessarily have a college degree, but could still have a solid middle-class job that was steady, that was reliable, came with decent benefits. And what David Otter and his colleagues show is that really since the 80s, 70s, and 80s, the American economy has started to shift. And we see those jobs disappearing, those middle jobs disappearing. And we see growth at the high end with, those computer jobs and managerial technical jobs. That's going great. And we also see a shift toward lower skilled jobs. I mean, in many ways, they're not low skilled jobs, but they're not skilled jobs that have skills that are valued by the labor market. So that might be food preparation, retail, private security. Those jobs have fewer benefits and much, much, much more instability. And so Janice, who you're mentioning, the card dealer, she works at a casino in Mississippi. She's a very religious woman. She's really lovely. She doesn't gamble herself. She's very against that. And yet, as you're saying, there's an irony. Her livelihood is bound up with the fates of the gamblers because she depends on their tips to make a living. And it's people like Janice working for tips, people like Jeremy working on commission, but it's also lots of people who are working in retail and the service sector who have hourly jobs, but those hours are also going up and down depending on what the employers are willing to give in any particular week.
Yeah, I have some experience with earning a variable income. When I was an undergraduate student, I picked up shifts as a bartender at an opera house, and so I earned, but it was on a seniority system. So in order to get the good shifts, I needed someone else higher than me in seniority to, be busy or have work elsewhere. And so I earned a, decent amount on the side for a student, but it was some months I'd earn a lot, some months I'd earn very little, but I wasn't entirely dependent on that income to pay all my bills or handle my expenses.
Yeah, so imagine that you had a family at that point and you had kids and everything was on you. It would be creating a lot of anxiety.
Yeah.
And I think that's a big part of the story these days. I mean, it's really striking. The unemployment rate in the U.S. is low. It's under 5%. But there's still a lot of anxiety. And it's a kind of a puzzle until you spend time with families and start to see this.
Yeah. So the other side of the volatility that these households face is the expense side. I'll share a personal anecdote. So last week, I brought my car into the shop with the check engine light on. And it turned out that rodents had got into it and chewed up all the wiring. So the repair ended up being quite expensive, $1,500. But, I don't know how much of that's going to be covered on insurance. Still, hoping that most of it will. But, this is the kind of unexpected thing that can just happen to anyone. Anyone with a car could have exactly this happen. How do the households in your sample deal with sudden unexpected expenses?
Yeah, it's really interesting. And your story is very typical, right? Lots of people are expecting some income to come, it doesn't come, or they have a health situation. A lot of them chose high deductible insurance plans under Obamacare or some other insurance scheme. And, that meant when a health problem arose, it was, $400, $500 out of pocket. So it was sort of the equivalent of what happened with your car. And then there are the cars that break down and there are the roofs that need to get fixed. So people did a lot of stuff. Some of them had savings. A lot of them borrowed. They put it on credit cards. After credit cards, the biggest thing people did was go to family and friends. That was pretty striking. But family and friends turned out to be a huge part of the financial network of families that are dealing with these issues. So treat your friends nicely and treat your family nicely because they're more than friends and family. They're also often your economic lifeline.
It's funny that the typical advice that you hear is, neither a lender nor a borrower be, right? And if you borrow from your family or lend to them, then that might cause you, it could potentially damage those relationships if you're slow paying them back. But it seems like for people who really have a lot of uncertainty in their spending and their earnings, that maybe they don't have the luxury of taking that advice not to mix finances and family or friendship.
Yeah, I think that's right. I mean, I think you don't have a lot of choices. One of the things about living a life of volatility is that it's very hard to put away money for the longer term or to build up emergency funds because your resources are going to dealing with the ongoing volatility. And so when the sort of extraordinary things happen, and maybe your car wires just get eaten by rodents, then you really, don't have that many options. And it could be a credit card if you're fortunate and you still got some credit available. But when those things aren't there, then, you're often inevitably looking to your family. I want to give you a sense of we've been talking about volatility. I want to give you a sense of just how extreme the volatility is that we saw. And there are lots of different ways of measuring it. Economists usually would measure coefficient of variation or do something formal like that. And we did that as well. But the simplest way to show how much volatility there was that we looked at monthly income and we counted how many months every family had where their monthly income was 25% or more above average. Right? So we call those spikes. And we did the same thing for dips, 25% or more below average. So that was like a big spread. And what we found, like, on average across our whole sample, these 235 households, was that households were spending about 5 months of the year, so 5 out of the 12 months, with income that was 25% above or below average. And then we found fairly similar things on the expenditure side. So you've got lots of ups and downs, both in what your spending needs look like and what your income looks like. And that's a really hard place to be.
Yeah. One would think that, the typical thing we do in economics models, in like the life cycle model and others, you take that volatility and you smooth it. So, in the extreme case, you spend exactly the same amount of money every day and spend the last dollar on the day you die. But that sort of assumes that an access to perfect credit markets and that you can save and you can borrow freely and that you have some kind of knowledge of where your income's going to be down the road, so you can sort of forecast your lifetime income. Those assumptions would seem to be violated here.
Yeah, and it's really interesting that you mentioned the life cycle model, because it is so much of how we as economists think about the world, the life cycle permanent income hypothesis model. And when we test it, we're often looking at how well households do with big year-to-year changes, right? Even there, it doesn't, always hold so strongly. What's different here is that we're taking that life cycle frame or that permanent income hypothesis frame, that, like you're saying, households be looking forward and they'd be saving or borrowing to smooth things out. But we're looking at month-to-month changes or week-to-week changes. And there we're actually still seeing a fair amount of illiquidity, instability and illiquidity. And that's getting smoothed out by the annual data. The annual data smooths all that out. So when we're testing the permanent income hypothesis in the yearly data, which we usually do, we're not able to see, these ups and downs, these bumps that this data set allows us to see. And that gives us a very different picture. And that picture is really all about illiquidity, people just having a hard time saving and having a hard time borrowing. And that leads to lots and lots of ups and downs.
Yeah. So you mentioned credit cards. How do payday lenders come in? Are a lot of people in debt to these sort of fast, high interest loans that are made available to the poor in a lot of places?
Some people are. And, when you're visiting Janice in her town in eastern Mississippi, on the way to the highway, there's just a row of payday lenders, on the ramp out to the highway. So they're definitely there. They're staying in business. But what was really interesting is that for the most part, the households we got to know are staying away from the payday lenders. They might have had some experience years in the past. They know how troubling engaging with the payday lenders can be, and they will do anything to avoid getting into those traps. And the national data shows something similar, that you've got households that use them fairly intensively, but it's a very, very small group. Most households are not using payday lenders. Enough are using them to keep the payday lenders in business. But in general, the households we got to know, they're putting money on credit cards and they're turning to family and friends, and they're avoiding payday. So I don't want to minimize the problem with payday, because those guys are out there and they're really preying on households that are in trouble. They're providing some useful liquidity, but they're doing it in a way that's not that helpful. So I don't want to minimize it, but in fact, it's easy to overblow their importance in the big picture.
So I guess the other source of income that at least some families can turn to when their income falls unexpectedly is the state. What's the relationship between a lot of these families and the various welfare programs? Do you see a lot of reliance on them? Do you see them working fairly well for the problems that these families face?
One of the things that I didn't expect, because I live in Princeton, New Jersey. I teach at New York University. So I'm I have experience in 2 states which are reasonably generous in terms of welfare programs. What I didn't really understand viscerally was just how variable government programs are state by state. I mean, I read reports and I understood that places like Mississippi, chose to allocate funds, differently than say a California or a New York. But until one sees it, it's hard to really understand what it means in people's day-to-day lives. So, in Mississippi, for example, the, access to state benefits was much more limited and harder to get than in what we saw, say, in California. So households are using them. The biggest ones, and I should say we weren't looking at Social Security so much, but the biggest ones are SNAP, food stamps, which turns out to be really helpful, not just for poor households, but you can be eligible if your income's up to 130% of the federal poverty line. So people who are not poor were also having some access to food stamps. But the biggest one for sure was EITC, the Earned Income Tax Credit. And what's so interesting about EITC is that, it really expands your tax refund, usually comes in February or March, and households aren't able to see how much of it is due to the state. It's just your tax refund. Right? So some chunk of it is EITC, but it's hard. You don't get a letter, as far as I understand, that says, 39% of this was from EITC and the other 61% was tax refund based on your over withholding. So the tax refund comes and it just feels like it's yours and that you earned it and you deserved it. And there's some great work on this by sociologist Kathy Eden and a bunch of her colleagues. A beautiful book called "It's Not Like I'm Poor." But people get it and they aren't able to fully connect the dots back to the government appropriation.
Yeah, the funny thing, EITC, it's designed to phase in as you earn more income. So the idea behind the proposal and behind why economists like the EITC is that it encourages work rather than discouraging it by giving you a negative marginal tax rate, at least on that one program. But of course, if it's not well publicized, if people don't understand the relationship between their earnings and the money, one kind of thinks that that would defeat the purpose, sort of not have the same incentive effect that we'd like it to have.
That's interesting. I'm not sure. I mean, the people we got to know are struggling, so they're working hard. Any extra income is going to help them, and so they're already working hard. Mm-hmm. I think what's nice about the EITC is, you can think about the incentive effects as being positive or negative. And so it may not have positive effect in the sense of juicing any extra dollar you get when you're in a certain range, because I don't think people really see that. But at least it doesn't have the negative effect, which I think was the main purpose of designing it, with that phase-in property. It doesn't have the negative effect of, having a clear threshold. And once you're over that threshold, you no longer qualify for support. Instead, as you're saying, it has a phase-in. And so people understand that they're not being penalized. So it doesn't have the negative quality, even if the positive quality may not be totally internalized.
Do you see, of course, there are other policies that do penalize you for earning more. Do you see people particularly aware of these and maybe responding to them by trying to reach the limit and not go over a certain threshold that would cut off their access to certain programs?
Yeah, it's interesting. I think the most clear example of that has to do with asset limits. And there's when you're in certain kinds of public housing, and mostly they've been lifted for SNAP, but there's some programs which have asset limits. So if you have too much savings, you don't qualify for the government programs. And there we do see that people are paying attention to the asset limits. And if they're saving, they're trying to do it on the side or in some other form. One person we know was saving with his mother, partly because she was really helpful in keeping him disciplined. It's easier to save with someone else's support than if you have to just do it on your own. But partly we suspect that he was also saving with his mother because he wanted to keep below the asset limit that was going to deny him public housing if he ever needed it. So there is some of that going on, which is a problem. And there was an interesting paper I saw in the past year which said that when the asset limits are raised and people are allowed to save, even if they're on government programs, when they get off the government programs, they're less likely to slide back. They're less likely to use them again. And that's because, they built up some assets, and that allows them to be more self-sufficient immediately. So in many ways, the asset limits, well, they're designed politically to make sure that people who don't need government resources aren't taking them from more needy people. In fact, I think the weight of the evidence suggests that they're counterproductive because they seem to be pushing people back onto the government roles who otherwise, people would prefer not to and who want to be more self-sufficient.
Yeah, that's interesting. And it's especially interesting that this person didn't live in public housing, but was just aware that if he ever wanted to, if he ever needed to, he had to keep his savings below a certain amount. It points to a sort of broader disincentive effect, not just on the people who directly live in government housing, but also on all the people who are aware of it, who are aware that it's an option or a possibility that they might need to use if they ever fall on hard times.
Yeah, totally. People were generally aware of what the rules are, even though with like the ITC, they didn't exactly know how it was playing out for them.
Yeah.
I want to get back to something. We were talking about tax time, we were talking about EITC, and one of the things that Becky and Jeremy were doing, the truck mechanic, was over withholding. So he was claiming fewer kids than he actually had. He had 4 kids, but he didn't tell his employer that he had 4 kids when he filled out, the forms to withhold taxes every month. And that meant that more taxes were getting withheld. But that then meant he got a bigger tax refund. Didn't affect his EITC, but it meant he got a bigger tax refund come January, February, when he eventually got around to filing his taxes. And that was really interesting because, tax advisors and economists would say, that's insane. That's crazy. Why are you, over withholding on your monthly paychecks? You should be taking that money, putting it in the bank or putting it into some investment and getting a higher return rather than giving the government a free loan, essentially, for a few months. And so that was striking to see, and a bunch of households were doing that. And I said to Becky, like, what's your thought there? And she said, we tried to save. So we tried to follow the advice. It's just super hard to save when you've got all these different calls on you. And so there was a lot of behavioral economics going on. They understood that, and they essentially saw the over withholding as a cost that they were paying for a service that provided disciplined savings. They saw the government, in a sense, as their partner in having a disciplined savings program that they would, ultimately be able to then get a big chunk back in January and February, and they could use that, in whatever ways they needed. So the tax system, it's been interesting. We see that a lot of people see that tax refund moment as a time when people can take that money and save it and put it in something else. But we saw with Becky and Jeremy was something pretty different, which was they had viewed the month by month over withholding as a process of saving already. They'd done their saving. And then when they got the money in January and February, they could spend it on their kids or whatever big expenses they had that they've been waiting to spend on.
Yeah, that's really interesting. So yeah, you mentioned the behavioral economics. You're sort of alluding to time inconsistent preferences or hyperbolic discounting, where, if you ask someone if the kind of decisions people make about saving in the moment are different than the ones that they would like to in the long term. But it seems like Becky and Jeremy are sophisticated about that. They know that in the moment, if they have a pile of money in the bank or in some liquid asset that they could easily take out, then they would. And so to force their future selves not to do that, they're using the government as a way of sort of holding money. So that's really interesting, and I didn't know that you could even do that, to be honest.
Yeah, advisors will tell you not to do that, but financial advisors generally think that most people have are able to execute their plans. But if you're living in a small town in Ohio, on your own, it's a struggle. One of the things now that we're talking about behavioral economics that struck me was that behavioral economics has focused on exactly those problems that you're describing, right? Where you have a kind of a future self, essentially, and a current self, and they're in some struggle, and your future self often wins out because, hey, you want to consume now, your future self wants to save, and, unfortunately, your current self is the one making decisions, and so they always outweigh the future self. So people see that, and like you're saying, they're sophisticated about it. But one of the things which I think behavioral economics hasn't paid enough attention to is that the solutions that are often proposed are ones that involve discipline, imposing some kind of outside discipline, right? Like putting your money in a savings account that locks up your money and won't let you get it until a certain period has passed. So they imposed discipline. But Jeremy's over withholding was exactly like that. It imposed discipline. But for lots of other households, we saw that it wasn't so simple. Say Janice, the card dealer in Mississippi, she knew she needed discipline in her saving. She made most of her money in the summer. She was worried about not having enough money in December when her paychecks were low. She understood all of that, but she didn't want to lock up all her money because she knew, given the instability we've been talking about, that she still might need to get access to it. So locking it up, totally locking it up, wasn't going to work for her. That would be too dangerous. So she had to find a way to balance structure and discipline, which is what development economics is really focused on, with some kind of flexibility, which is driven by living a life of instability. So you've got these two things which are really at odds: the need for structure versus the need for flexibility. Right? And it's hard to get them in the same kind of financial product. So what we saw was people doing all kinds of workarounds or inventing all kinds of strategies. So Janice, she opened a bank account an hour south, and she put her money into this credit union with really, really lousy hours. And what's more, just to make it even stronger, she had an ATM card that she could use locally, and she cut it up. Just simply cut it up. So if she wanted her money, she'd have to drive an hour to get that money out. And she said, hey, that works for me. This is great. And her logic was she had the structure of having the money safely away and out of reach or out of easy reach, but it wasn't 100% locked up. She knew that if she needed that money, she could get in the car and she could drive down there and she could get it. And we saw her do that a few times. Back to school, her grandson needed some back to school supplies and clothes. She did make the drive. That was her way of getting the flexibility together with the structure. And we saw lots of families trying to figure out the same kind of thing.
Yeah, okay. So that's really interesting because it's an in-kind cost, right? You have to get in that car and sit behind the wheel for an hour each way, where maybe a monetary cost wouldn't work. So there's some investments you can make where there's a penalty to pulling it out early. But if you're worried about your, discipline with money, then a monetary penalty is not going to be a good incentive. But if, a real effort sort of task like driving makes sense, that you'd think twice before getting in the car and driving all the way out there. So it's some really a good strategy for self-discipline. Quite smart, really.
Yeah, I mean, it's interesting with the monetary policy, monetary penalty, it could work, right? But we often set them really high because we really wanted to discourage people, taking their money out of retirement accounts, right? Or something like that. So they're set high to dissuade the activity. Whereas for the households, they want a different kind of balance. They want to be able to get access when they need it. They need some kind of barrier, but not too high. That's the key, finding the optimization. I mean, Becky and Jeremy, they had a 401k, and every time Jeremy moved jobs, he pulled the money out of that 401k. That wasn't so great. And so what a behavioral economist might say is we need to really raise the penalties and make sure that Becky and Jeremy don't do that in the future. But that's actually not, to me, necessarily the right thing. What people are starting to talk about is having retirement accounts and other accounts which are structured and disciplined and hope people keep their money in there, but coupling them with another account which is flexible, which allows people to get money when they need it, so they don't have to deplete the structured savings. So Janice, with her bank an hour away, was figuring out some way of doing that. Other households did other things, and retirement plans and others are now starting to figure out how to actually make that a real financial product that millions of households could take advantage of.
Mm-hmm. Yeah, because I have in mind and some experimental economics research where they do the tests for the time inconsistent preferences, but instead of using cash as the incentive, they use forcing people to do something really boring, like read a sentence and count the instances of the letter E, and do that for like an hour, and then you pay them up front, but you let them make choices that allow them to reduce the amount of sentences they have to count the letter E in. And the finding from real effort task research like that is that people respond very differently to real effort incentives versus monetary incentives. So yeah, and I guess the other nice thing about it is it's not punishing, where our incentives on the one hand, they incentivize, they lead people to certain behavior that we think are desirable. But, you don't want to, if they deviate from that behavior, punish them so much that you're actually making them much worse off.
That's really interesting. That makes a lot of sense.
So you asked the households in your sample some questions about financial literacy. For instance, you asked them whether a $100 investment in a savings account with a 2% return will have more or less than $102 in 5 years. Answer is, of course, it will, because after 5 years, it's got that 2% return 5 times. But they're sort of basic questions about compound interest for the most part. However, these are sort of standard questions to measure financial literacy, but you also argue that these sorts of questions and sort of brain teasers about compound interest aren't really relevant to the kind of financial literacy that people actually use and actually need. So could you explain the distinction there? What is useful financial literacy for a typical household in your sample?
Yeah, no, I'm glad you raised this. It's really interesting, and we need a bigger conversation on this. And we, not just you and me, but we as a society. One of the things, just to be narrow about it, is a lot of those questions are about compound interest, as you say, and they're about saving. But in a low interest rate environment, that's really not practically that important. Where the action really comes is on debt, and understanding the interest on debt and the compounding of interest on debt is much, much, much more important. But that's not what we're teaching, and that's not what we're testing. But I think the bigger thing, if you think about Janice, the card dealer in her bank an hour away that we were just talking about, what she needs to figure out to do to be able to save like that is to have self-knowledge, to sort of understand this basic problem. So she needs to, use the word sophisticated. Her financial literacy that's relevant is being knowledgeable about the kinds of temptations that financial decision makers face and being aware of the kinds of options that one needs to put in place in order to solve the problems. So her choice wasn't about compound interest or anything like that. She wasn't thinking about that. That wasn't a dimension of the saving choice she was making. Instead, she was thinking about structure. She was thinking about flexibility. She was thinking about costs. Like you're saying, she was thinking about in-kind versus other kinds of costs. That's the kind of financial knowledge. It's more behavioral. It's more about execution that people really need to have. We saw folks who had great financial literacy by the book still not being able to save because they didn't have that self-knowledge. We also saw people who just, struggled with the financial literacy questions, really couldn't answer them, didn't get compound interest. You couldn't, answer a simple question about inflation. And yet were making some pretty good financial choices because they knew themselves and were thinking strategically in a way that's more important.
Yeah, you talk about people in the book who are, really, some of them are really experts on saving and scrimping every penny, so you have people who are cutting out every coupon or finding free movie tickets, knowing the websites to go to where you can find that. I actually didn't know those existed, so I'm probably going to see some free movies as a result of your book. But
check it out.
And I know from my own experience, like some people who are just really interested in saving money and on being frugal, they learn things like, how to do some basic car repairs, and cooking for yourself is a big one rather than eating out. So it seems like there's a lot of very specific expertise that people apply, and that wouldn't show up in a quiz about compound interest.
Right. So there's specific expertise, but at a higher level, it's kind of generic expertise about budgeting and sort of understanding your pain points or your challenges. So I'm not sure how you'd boil it down into a 5-question test, but I could imagine how you might boil it down into a curriculum to help people become more aware and make these challenges more salient to those who aren't already thinking about them.
So a recurring theme in your book is that there's this sort of body of standard or typical financial advice given by gurus and academics and talking heads on TV about start saving early so you can get compound interest, so you can retire when you're 65, and here's how you maximize your tax deductions, and and here's how you save on, here's how you have a retirement savings account that lets you spread your taxes over your lifetime. And those seem perfectly calibrated to someone who has very consistent regular income and expenses, and they in a 401k, and they just they know where their income's coming from. They know very precisely what it's going to be, next week, next year. And a big consistent part of your book is saying like that really doesn't apply to a lot of these households. Do you see an alternative sort of, what would be the financial advice that households with more variable income and expenses really need, rather than the advice that they're getting for the most part?
Yeah, I got to say, you just put it beautifully. And the advice that is given is really great advice, but it really just applies to, a portion of the population. And that population tends to be more secure, more stable, better off. So great advice for the top end of the distribution. But the middle of the distribution, of the income distribution, it's not such great advice, because you're dealing with short-term issues as well as long-term issues. So most of the advice is life cycle advice, long-term advice. But for a lot of people, as you're saying, they can't get through the short term. It's hard to get to the long term, or to even think about it. You don't even have the bandwidth. And so if I was going to start thinking about advice for people who have pressing short-term kind of instability, it would be to, begin with it would begin with taking the consumption smoothing model more seriously, the permanent income hypothesis model more seriously. We often see that as a long-term model of consumption smoothing, but it's also a short-term one. And financial advisors will say, build an emergency savings pot and put, 3 months of income away in case you lose your job and it takes a while to get a new job or something like that. That's pretty good advice. But what I would say is there's this other pot of savings that you need to think about, and that's short-term savings that allows you to buffer the ups and downs as they're coming month by month. It's a very active kind of saving. It's not like you build up the static pot that can then just sit there for a rainy day. It's not like that at all. It's money that you build up with the idea you're going to take it down when you need it. You're going to build it up again, take it down, build it up, take it down. It's active and very necessary. So if you don't have it, then you're putting stuff on your credit card. You may be tempted by the payday lender. You may have to go to family and friends. And so the key advice, or the key area that I would focus on, is short-term consumption smoothing kind of savings. And that's not really a conversation one's hearing much about.
So your previous work, a lot of it deals with development economics. In fact, you worked with, doing a similar type of survey approach to looking at households in the developing world, in India and I believe South Africa.
Yeah, India, Bangladesh, South Africa.
Okay. So how does development economics apply, or what's the connection between people in some of the poorest parts of the world and people who are relatively much richer but still face this volatility? Are they very different, or are there some broad similarities?
It's a really interesting question, and one that I've been thinking a lot about. My sense is this: when one is focusing on the challenges of poor families in India and Bangladesh, for example, talking about the short-term problems and talking about illiquidity, it's very natural. What's missing from those conversations often is thinking about long-term investments. And I think that's a real problem, something really missing in those contexts. So coming from development, it's very natural to think about short-term consumption smoothing and illiquidity. What's striking is you come to the US and those issues aren't on the table. It's all about the long term. So my sense is there's really a convergence on both sides, that on both sides, we need to think much more about how the short term and the long term are fitting together, and how the short term creates a platform for long term investments. We can't take it for granted. We really have to help families build that up and take care of the short term issues. And so I see a convergence, but in neither place is the conversation really there yet, for different reasons. So if that makes sense.
Thank you very much. My guest today has been Jonathan Morduch. Jonathan, thanks for being part of Economics Detective Radio.
Yeah, this is great. Thank you. Yeah, I really enjoyed it. Thanks for this opportunity. I really loved your questions. I wish there were more questions and more conversations like this, one of the things I hope to do going forward is try to do some writing that connects more of the dots that you are raising, right? Because the book, as you know, is kind of written for a broad audience, but I'm going to start writing some things for economists, and you've already anticipated a lot of the issues. So I really appreciate your giving the chance to start talking some of that through. Awesome. This is great. Thank you so much.
Thanks. If you enjoyed the episode, I encourage you to head over to economicsdetective.com, where I'll have show notes as well as a link to the book so you can buy a copy if it interests you. I think it's a particularly well-written and interesting book with lots of anecdotes like the ones we shared on the show. So head over to economicsdetective.com and maybe leave a comment. It's nice to hear from listeners, and for an episode like this where we talk about a lot of people's personal stories and how they cope with instability and wildly variable earnings and expenses, maybe you're one of those people. Maybe you have 5 months out of the year where you earn a lot more or a lot less than you do on average. I'd like to hear about it, so head over to economicsdetective.com and leave a comment on the show notes page. Thanks.